Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers, and I'm here for what we learned in the markets this week. Our last video of August, where has the summer gone? Remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets and what's going on with the economy, while also drowning out the agenda of the news media in America. So let's talk about the 4 things we learned in the markets this week. Point number 1, oh goodness, the major averages fell for a second week in a row in a Federal Reserve induced sell-off that continued to gain steam throughout the day Friday. It just kept getting worse and worse and worse and worse. For the week, the Dow fell 4.2%, the S&P 500 dropped 4% even, and the NASDAQ, your more growth-oriented investments, growth funds, fell about 4.4%. Now, Federal Reserve Jerome Powell at the Fed's annual Jackson Hole meeting spoke on Friday, and this is what he said. This was his exact quote. "Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy." So, all right, let's talk through that in layman's terms. The Federal Chair Powell is telling us, don't expect us to drop rates in the near term or relent on any of this restrictive monetary policy. Interest rates, the higher they go, the more adverse effect they have on stocks and bonds. This is one reason why we encourage you to talk to your advisor about the merits of adding real estate to your portfolio, at least for the foreseeable future. Point number 2, let's use bank loans as a proxy for an economic indicator to provide us some guidance on the health of small businesses and the consumer in America. Now, every loan category that we reviewed from data we received from the Board of Governors of the Federal Reserve shows lower delinquencies today than before the pandemic. For example, mortgage delinquencies. Today they're at 1.96%. Before the pandemic, quarter 4 of 2019, 2.34%. Credit card delinquencies, 1.81% today versus 2.63 in quarter 4 of 2019. And business loans, they were at 1.09% in quarter 4 of 2019. Today, 1.03. One item we would note is 2019, the economy was doing excellent. So those numbers were already low and already good. And to be even lower today is a really, really good sign. Now, watching recent trends, we see that credit card delinquencies are the only category that are currently rising, while mortgage delinquencies have actually been going down, which is consistent with a strong real estate market. And this is good data, one that we're going to continue to keep an eye on, although the only way to ensure that you don't have delinquency in your life is to follow the baby steps and stay out of debt. Dave Ramsey did extensive research, and here's what he found. 100% of foreclosures happen on a home with a mortgage. So get that mortgage gone and live like no one else. Point number 3. Do you wonder how much supply chain issues impacted the inflation rate versus just stronger consumer demand because of the pandemic delaying buying decisions and then massive government handouts? Well, we looked at the New York Fed's Global Supply Chain Pressure Index to answer this question with the help of our friends at our research firm DataTrek. Supply constraints peaked in December of 2021 at a 4 standard deviation above the long-term mean. More recently, it's at a 1.8 standard deviation above the long-term mean, which shows that the supply chain issues are easing. They're going the right way. And with the Fed's model, we can see that strong consumer demand was the core driver of U.S. inflation from 2019 through 2021, accounting for about 5 to 6% of the 8.5% inflation rate over that period of time. So even with a clean supply chain, we'd still be well above the long-term inflation target, giving the Fed the confidence to keep rising rates to slow the economy and curb that consumer demand. Now, one problem released this week, Americans are getting $10,000 to $20,000 back to spend because of student loan repayments the governments are giving. It seems that one side of the government is trying to curtail demand, the Fed, while the other side is stoking the fire, the presidential side, with the student loan forgiveness. For more information on the student loan relief and how it may impact you, go to the blog section of our website or check that out in the notes of this video. You'll find a great article written by our financial advisor, Andrew Young. Point number 4, coming back to the Federal Reserve, here's what the Fed funds future currently puts the odds of future rate hikes. Currently, right now, the September meeting, there's a 50 basis point hike projected with 48% confidence and a 75 basis point hike at 52% confidence. So basically even odds that maybe it's 50 basis points, maybe it's 3/4. By December, the Fed funds future expect rates to be at about 3.5 to 3.75, which puts them 1.25% higher than today, which means there will be more future rate increases even after the September meeting based on current conviction rates. The highest conviction odds for July of 2023 are also at 3.5 to 3.75. So after this year, nothing really is expected in terms of rate increases. But let's see after today's Fed talk what the futures look like, the funds futures look like next week. Now, as always, we appreciate your continued confidence in our firm and our advisors. If you have specific questions about this information and how it may relate to your personal situation, reach out to your advisor. And the notes, we have the link to schedule a meeting with us. And also, do us a favor, click subscribe on our YouTube channel to become one of the subscribers. So as we release these videos, you are one of the first to get them. You don't have to wait for the newsletter to come out to get them. We've also got some tax videos getting ready to come out later next month with our CPA on staff and some of our other tax team. That is going to be great information. So we look forward to continue to providing valuable advice through the video channel of Whitaker-Myers Wealth Managers. Thanks so much. We look forward to talking to you next week.